You know what? Having the stock market being down is not always a bad thing. Actually, some great companies could be offered at amazing price, especially for retirees. Right now, it is your opportunity to catch up those stocks offering you a 4 and maybe sometimes 5% yield that are safe, but the market panics and they offer you this opportunity. Today, I've used the DSR REIT screener to look at Canadian REITs to see if there was a few one that I could find where they show constant distribution increase, a yield above 4%, actually 4.5%, and I stopped my research on 3 of them. So let's get into that screen and see what I found for you guys. All right, so here we are on Dividend Stocks Rock, and we're not just about stocks, but we also have a REIT stock screener for our members. So in the analysis part, we do have the stock screener, a ETF screener, but today we're going to stop into the REIT to see some high yielding companies that will not let you down even during a recession. I've applied a short filter here just to summarize my research. So what I want to do here is to look at the Canadian market, and then for the pro rating and the dividend safety score, I'm going to set them at 3. The reason why I do that is I don't want to have like some bad companies. I don't want to have like dividend cutters or REITs showing a very high payout ratio that has not been able to increase their distribution, because as the interest rates are increasing and it's not the end of it, well, those REITs are likely going to cut their distribution at one point. So I want to make sure that I have a REIT that shows a dividend safety score of 3, meaning that the increase is stable, probably between like 2 to 5%. This is what you can expect from a REIT, especially when you're looking at high yield. And for the dividend pro and for the DSR pro rating, I'm looking at everything that is rated either as a hold, a buy, or a stellar buy. Between you and me, we're going to just look at those buys, but I just wanted to expand my research a little bit. So once I've put those filters, I have all the other information on it. I could download it into an Excel spreadsheet, and that gives me already the choice of 23 REITs, which is probably too much, right? I'm going to spare you the extra research I've done, and I'm going to highlight a few of them, sorted by the pro rating. So we're going to look at today at Allied Properties, Canadian Tire Real Estate, City REIT, and we're also going to look at Killam Apartment REIT. I could have looked at Canadian Apartment REIT here. I could have looked at Granite or Enterrent, but I wanted to have like 3 different REITs from 3 different industries just to give you a good look of what is looking for. So now let's go at Allied Properties. Right here, so a company showing a strong occupancy rate. The payout ratio is in order, so already we're on a good start. The yield at 6.25, I like that, especially if you're looking for a stable income. Dividend growth since 2013, and it's a monthly distribution. So already on a very strong start here, but now we have to look at what Allied REIT Properties does exactly. So this one is a closed-end real estate investment trust, owner-operator, distinctive urban workspace cities, and network-dense urban data center in Toronto. So we're looking at offices mostly. You can see Montreal, Ottawa, Toronto, Kitchener, Calgary, and Moncton. So all the big centers in Canada. Going a little bit further here, let's look at the latest quarter. So every quarter we have a team looking at over 1,000 stocks, and we do kind of like a press review of what happened during the quarter. So what I see here, my attention is 11th revenue growth, so double digit, but only 2% for AFFO per unit. So it's really important to not just focus on the revenue growth, but also the AFFO per unit. So when you see that the AFFO per unit is not growing that fast, only 2%, this is usually explained because they have issued more units. A lot of REITs does that. They issue units to finance their project, which totally makes sense. The important part here is the AFFO payout ratio is at 79% for the quarter. So you don't really have to worry. Even though the REIT shows a high yield, the dividend looks very safe at this point. So let's go down a little bit further. We have our investment thesis. So we are talking about a REIT that has one of the strongest balance sheet among Canadian REITs, which obviously you like. One thing that is really important is they have a unique expertise in managing and developing prime heritage location. When we invest in REITs, we usually say it's about location, and also location. So there you go. Allied REITs have properties in prime location. 70% of their income is generated from offices. So you can think of office and then parking revenue. Obviously, during the COVID, parking revenue went down. It is hard to bounce it back right now as well, mostly because a lot of people are not necessarily going back to work every day. So it will be hard for Allied Properties to show similar growth in the future. As you can see, we had a big price drop during the pandemic, but now the stock is actually trading at a lower price compared to the crash, which is kind of like a bit concerning, right? When we look at the revenue, they're clearly stable between 2020 and 2022, slightly on the uptrend. So I'm not too worried about that. For the earnings per share, we're not going to look at that because we're talking about a REIT, and REIT is all about FFO per unit and not about earnings per share. But what I really love here is to see a classic monthly distribution that is going up slightly but surely every single year. So we're not talking about a huge increase, but something that is always good, show management confidence. And this is what you're looking for right now when you want to invest new money into a REIT. You want to make sure that this company has enough money to increase its distribution. Going further, I mean, I've painted a pretty nice look of pretty picture of Allied Properties so far, but there are some risk here. Bear in mind, 70% of Allied income is related to offices. And it's uncertain for companies when they will renew their lease, if they will take as much space as they are right now. Maybe they're going to reduce, and then all office properties REITs will have some problem in terms of occupation. So we'll see how it goes. The other problem also is obviously the interest rates that are keep rising. I mean, almost every month right now, and we're not done with that. So the cost of debt will grow throughout time. And when you look at the debt graph, well, it's pretty much a straight line on the wrong direction. So Allied Properties will have to address that or find ways to increase their rent to smooth their debt payment. But at this time, it's not a bad bad situation. You just have to consider that for future. In terms of dividend growth perspective, we're talking about like roughly 2.5% annualized growth rate year after year, which is okay, not incredible, but decent. The increase was of 3% in 2022, which is interesting. The monthly distribution payout ratio is still well under control at 79%. So for this one, I'd say that Allied could be a very good pick if you're willing to bet on offices in the future. Next one, I must admit, it's one of my favorite REIT, CT REIT, Canadian Tire, obviously. So this one is all about Canadian Tire. They have about 90% of their properties are linked to this iconic brand in Canada. Going a little bit further, you don't really have to look about the business model. It's all commercial properties. Most of it are tied to Canadian Tire, or it's other brands like Sport Cheks. And you have also other tenants like Save on Foods, Buy Low Foods, Loblaw, Shoppers Drug Mart. So those are very nice because they're recession-proof tenants. And for Canadian Tire, I don't expect the brand to crash and burn. But if you invest in this one, you have a high exposure to one tenant only. So it's important to follow how Canadian Tire does from one quarter to another. For the latest quarter, we have a modest revenue growth of 2.3% and AFFO per unit growth of 2.5%. So basically growing pretty much at the same pace. The AFFO payout ratio is at 75%. So again, your distribution is safe. You can count on more increase going forward. You don't have to worry too much about how CT REIT is doing over the short term. It is growing modestly but steadily. For the investment thesis, I mean, I like a lot of things about this one. The monthly payment, the 5% yield, the fact that they have their largest tenants is in an iconic brand. All of those things reassure me. I think the future for Untitled is pretty much bright. I mean, on top of being an iconic brand, they're pretty much Amazon proof or e-commerce proof. They have invested a lot in their e-commerce platform due to the pandemic, and also they manage a lot of their own brands like MotoMaster or Mastercraft. So when you cannot sell those brands elsewhere, well, you have to go to Untitled to have them. They also sell high ticker items, which is sometimes harder to ship, like boats and VTTs and stuff like that. So it's a little bit harder to ship online. It gives another advantage for Untitled. When you look at the dividend triangle, you can see that this one hasn't been hurt that much by the recent bear market. We're still seeing like a downtrend here around 2022, but it's not as bad as it was when we hit the pandemic crash in 2020 and all stores were closed. In terms of revenue, you can see, I told you before, 2.3 to 2.5% increase year after year, so it's growing slowly but surely. For the dividend, you have a perfect escalator going up, almost 4% annualized growth rate, which is a lot for a REIT. I don't expect dividend growth to increase that fast in the future, probably more around 2 to 3%, but still it will be better than not having any dividend increases. Again, this one looks very nice, but you have to be concerned about this exposure to Canadian Tire. So this gives you a little bit of extra work to follow two companies for the price of one. The other things that I'm a bit worried about is the fact that we're talking about brick and mortar retail stores. We're about to enter into a recession, while Canadian Tire sells a lot of products on discount and will attract a lot of people that are having a hard time to buckle up their budget. So many consumers, even though they will be attracted by discount at one point, if the budget is tight, they might not spend as much as they used to. You have to be careful about that. For the long term, shouldn't have a big impact, but over the short period of time, maybe Canadian Tire will slow down. Interest rates will obviously be a bigger burden going forward. This is pretty much the reason why all REITs are going down right now. It's a sector thing. Like, this is one of the sector that will be impacted the most by interest rate increase because they're highly leveraged. And you can see it's not a surprise, but long-term debt is also a little bit higher right now. So obviously the future debt payment will be higher, and this could be a problem down the road, especially affecting the dividend growth perspective. At this time, there's nothing to worry about. There's a lot of wiggle room to improve distribution. AFFO payout ratio of 75%. Not a problem here. And we're talking about a perfect example of a sleep well at night type of holdings where we get a 3% increase and then you get a 5% yield. The latest two increase in 2021, 2022, we were at 4.5 and 3.3. So again, pretty much online. In line with what happened in the past. We had a small increase in 2020, but at the same time, it proves the resilience of the business model. While some REIT cut their dividend, Canadian Tire REIT was still there to help you out and not fail their shareholders. So last but not the least, Killam Apartment REIT. I'm a big fan of apartment REITs right now, mostly because a lot of people may think twice or three times before buying a house. They might go into apartment instead because of the housing price that is just crazy. What I like also is that KMP is most of their revenues are coming from Atlantic provinces. So we're going a little bit apart from major urban center where the heat around the housing market is. So that is also something to consider. We're talking about a portfolio of almost 5 billion of real estate properties, which is quite impressive. Dividend yield at 4.5, dividend growth since 2017, and we're also showing a monthly distribution for this one. So again, if you're looking to build a budget and live off your investment income, Killam property could be very interesting on this. Killam apartment could be very interesting for retirees. For the latest quarter information, you can see AFFO per share up 4.3%, revenue up 16%. So there you go. Growth was partially offset by 9.1% increase in the average number of units. As I mentioned earlier, this is a common theme for REITs. They will show you a lot of growth. So they will buy more properties, they will grow through new development, but they will finance it through either debts or more units. But if they issue more units, it means that they have to pay a lot more in distribution with the same amount per unit. So you have to be careful with that and always look at the payout ratio. Right now, not a problem. We're at 72% actually, so from 75 to 72, so still very low. A lot of room for future distribution. Now, what I told you about apartment suites geographic diversification is amazing. So we have 34% in Nova Scotia, 23% in Ontario, a little bit of New Brunswick and Alberta. So this will help the REIT to continue to grow. They are a little bit sheltered from the big housing markets, and hopefully will keep their tenants for a long time. This is always something you have to consider. We're going to see that in the risk portion in a moment. For the dividend triangle, well, this is another REIT that got all the hype between 2021 and 2022, and then boom, it crashed and burns. However, revenues are still increasing. I showed you AFFO per unit is still increasing. The dividend is still increasing. So I'm not too convinced to understand what is happening there besides interest rates are rising. So I'm not sure what's going on here. I don't know why, but at 4.5% yield, this looks like a very good deal. For the potential risk, while KMP is somewhat sheltered from the big markets, it also limits its growth potential. So that's one thing. Interest rate is also another one. And the last one is if we fall into oversupply territory, well, apartment REITs will have to offer new apartments at same price, lower price, give promotions. So this could affect revenue, and at the same time you have a higher debt burden, and then maybe revenue will not grow as fast as it was before. So you were going to see some margin squeeze for a lot of REITs, and this is probably why the REIT price has decreased that much. So overall, I really like what KMP did. Actually, they went from AFFO payout ratio of 123 back in 2013 going back to 76% right now. So we can see that the management team in place noticed what happened in the past, focused on having a more profitable business, and now we're getting like a 2-3% increase year after year for the dividend. Latest increase in 2021 was of 3%, so it's going to match the targeted inflation rate. So not right now, the inflation rate is just crazy. You're going to have a hard time finding REITs matching the inflation now, but over a long period of time, those are the types of REITs: Allied Properties, CT REIT, and Killam Apartment. They will be able to match inflation and probably reward you even more. So now you have 3 choices of great REITs offering you yield between 4.5 to 6%, monthly distribution, some distribution growth history behind all of them. I love their business model. Obviously, there are some risks, we have discussed them, but at least it gives you a pretty good start to look into your research. Again, not a buy or sell recommendation. Do your due diligence, but at least you have a good head start, right? I would like to know in the comment section, what are your favorite Canadian REITs? I know I didn't talk about Granite today, but I've been talking about Granite for a few times, so I just wanted to offer you new opportunities. So you can tell me that Granite is your favorite one. It is my favorite one too. All right, so see you in the comments, and until next week, don't forget to stay invested.